That's all right. That's because I got the mic on mute. I do apologize for that. So, guys, if you're rewatching this later, don't worry, we'll timestamp it all. That should be nice and just in the sweet spot, I think. Fantastic. Okay. There's never a dull moment, is there, doing these things live and last minute? Beautiful. We spent a lot of time getting this sound nice and sharp, Brandon, so I'm glad you like it. All right, so 120 watching. Thank you all. We've already got 2 thumbs down. That's not a good start. Maybe that's because we're on mute. We'll see if we can get those 2 pleased by the end of the video. Yeah, maybe I am a boomer. Maybe I'm getting old. Too old for crypto. Alrighty, guys. Okay, so what we want to get into tonight is have a look at the stock market, because I think we are heading to a super cycle tipping point in terms of commodities and their prices versus stocks, particularly growth stocks, tech stocks. We know how much money has been printed, and we're going to talk about why that's going where it is and why that might all be about to change. It's all related. Money flows from one place to another, and at the same time as we've got record money being created. So we're going to talk about how that all interrelates, tied back to gold and silver, a few others, and then what I think is going to propel or kill the US dollar to some degree and drive everything else. So we are going to look at, give you guys a little bit of a preview of some of the precious metals research that we've been doing for nearly a year now as well. So if you're a member or if you're not aware, in the group or in the new Nuggets News app, which is very, very close now, definitely before the end of the year, those of you that are waiting, we have a range of precious metals reports, and they are under units, member-only reports, talking about macro stuff and gold and silver stuff. And we've got a precious metals analyst who's actually a mining engineer who's been helping us out with these, and they've really been fantastic. So anything that you see tonight, if you want to read in full, that's where you can have a look. All right, so let's have a look at the US dollar. The index is the DXY, something that we've been talking about for a very long time, as have others. And our friend Troy, I know plenty of you follow Troy in the group, but he in particular has been talking about this level here. So this is the first real, resistance, and if we're going to make our way back up, and that comes in at right around 94.60, and we touched it to just about the cent just yesterday or a few hours ago, and it has been rejected. A little bit of a comeback here. So this is the key level, okay? Tying together, you guys know how much I love to tie together technical analysis with fundamentals of what's going on, as well as sentiment, and that can be done in the macro world. It doesn't matter if it's $1 trillion Forex market or if it's the little cryptos as well, okay? You can still have some basic knowledge there and tie all this together. So this is the line in the sand. We're going to talk about what happens if we go down and roll over, or what happens if we actually break through that. And this turns out to be a bottoming pattern. Just quickly, if you talk about what was happening here, it was very similar to what happened during the middle of the year. You guys, plenty of you will remember the live stream that we did when everyone was panicking and everyone was asking us and my support staff about where can I buy US dollars because the Aussie dollar is crashing. And this was the day that we've got the most messages ever about how to buy US dollars. And it was the worst time to be buying US dollars, and people do the wrong thing at the wrong time. So that is a mixture of technical analysis where you can look at this and use any number of indicators. So whether it's, you get up your Bollinger Bands and say, wow, on a weekly chart, we are outside Bollinger Bands. That doesn't happen very often. So, you can tie all of this together and build a picture of what is going on. And everything in nature, or whether it's charts, things tend to mean revert. So go back to the mean and like clockwork. I said at the time, we're probably going to get a bounce here and some mean reversion. And, we went to the middle of the Bollinger Band. Some traders will take profits here, and that's why we have a little bit of a dip. And then it continued higher all the way through to the other side. So that is just one example. You could use the RSI, even if you're just using nothing else, and say, I'm going to buy when the RSI is oversold. Or as you get experienced, and if you made a mistake and you're one of the people that did the wrong thing on this day, you will learn. And the next time around, you'll say, you know what, I've got some very basic technical analysis rules that I'm going to stick by, and I'm never going to sell my Aussie dollars to buy US dollars when we're outside the Bollinger Bands on the daily and weekly time frame. And look, we're also oversold on the RSI. And they're those just little basic things, whether it's Bitcoin or gold or currencies that you can learn and they can protect you. So getting back to the DXY, and we had a very similar thing happen recently. And at the time, this was a capitulation, and a lot of volume would have been here where this technical level happened. And so that becomes a significant level of resistance again when we try to break through it. And here we are. It's been a pretty big run for the US dollar since it put in its, maybe a temporary bottom, but it's on the other side of the Bollinger Band now. So they're the sort of things where we look to add up and say, well, could this be a temporary top and we're going to have a little bit of a pullback? That can give us a little bit of a relief rally in everything from stocks that are priced in US dollars to gold, silver, oil, Bitcoin, whatever it is. Let's just quickly have a look at some other currencies because everything is priced in US dollars. And the DXY is a basket where the euro makes up the biggest component of that. And the euro's already not looking that great, is it? It's outside its Bollinger Band on the daily, not so much on the weekly, so it's got a lot of room to still go down there. So that's just a bit of a picture that I wanted to build for you of where we are. And I guess it's also good to think of gold as another currency. And gold, again, following our very basic rules, we were one of the few people few crypto YouTubers, I guess I should say, that were bullish all the way through. And I'm going to talk about some of you have followed me from back in the hot copper days when I was talking about gold and silver and Bitcoin, all the way back here when everyone was hating gold and silver, and that was the best time to be buying it. And obviously when we started the channel, we continually covered it, and a lot of other people were talking about how, gold's dead. Just these basic rules of, outside the Bollinger Bands, good time to buy. Outside the Bollinger Bands, capitulation, good time to buy. Above it, pullback. Above it on the weekly, bit of a pullback. This is just beautiful, I guess, technical analysis to follow. And here we are. What an amazing run. $2,076, and now we've pulled back perfectly all the way back to the middle of the Bollinger Band, which is also a 20 moving average, and a lot of traders will look at a 20 moving average as well. So the question is, has this nice little correction, which has now lasted 8 weeks or a couple of months, is that over? Same for silver. Is that all she wrote, or is this actually a larger time frame top, and we're going to start quite a more meaningful correction? So the Elliott wave guys will tell you that this is a top, and then we have a 1, 2, 3, and that's your correction. Candlestick traders will tell you that this is a nice hammer that's formed and we're outside a Bollinger Band. We're oversold on the RSI. So, these are all reasons where we can have a bit of a bounce here. And if we look at the fundamental picture, there's plenty of people that want to buy gold and silver. Now, some of the fundamentals that we're hearing, a lot of the flows into the ETFs have slowed, and there was a lot of profit taking or people that owned a lot of gold that were happy to sell it, but because of COVID at the time, it was very hard to move things around the world. And so some of those stories we heard about the ETFs running out of gold and the huge demand, a lot of these companies were sort of trying to sell, or even some maybe central banks, they were quite happy to sell at $2,000 an ounce, and take some profits. They can print more money out of thin air whenever they want. Maybe they saw a better opportunity in stocks when everything was crashing. So I guess, like we say, the dust had time to settle. Water's going to find its level, and we're starting to maybe see some of that physical demand be met from where it had to move around the world. That's basically the story here. And a lot of you maybe watching this video, this was the first time you bought gold and silver, and I spoke about at the time. Again, there was the lines and the pictures of people, queuing for hours to buy metals. And when things are going parabolic, that's not the time to buy. Particularly, I think it's XAU AUD is the Aussie dollar gold price, and we saw the photos of Perth Mint, Ainsley Bullion, those type of things. When gold's up at nearly $2,900 an ounce, a lot of people made that same mistake. You'll remember towards the middle of the year, I think it was, wasn't it? When we did those videos, a lot of FOMO, and we sort of said to people, buy a little bit, but dollar cost average in. There's probably going to be a pullback. And sure enough, you could have bought it 2,750, or you could have waited and got some gold back here at 2,400. So look, whenever things go parabolic, there's usually a bit of a pullback. Just something to keep in mind there. A few others we'll just look at really quickly. It's just crude oil futures. Remember, we went to a minus 40 a barrel. That doesn't come up on the charts anymore, but that capitulation, and it's bounced back to $40. There's a lot in the works there. We might not get into oil too much. We'll drill down into that, pardon the pun, with Marin Katusa next time. But I think this is one that, even if we're heading into this recession, depression, and there's a lot less oil, there's also a lot of the mining rigs that have turned off because they're not profitable at that level. A lot of these are hard to come back online. This is another reason, and I know some people hate the whole renewable energy thing, but I think out of all this, we will probably get a lot of money thrown at that. So maybe that is a little bit of competition. Now, we're never going to get rid of oil within a few years. It's just, it's in everything, and I think people do forget that sometimes. But this has been a very interesting market this year. Minus 40 to 40 within 6 months. Crazy stuff. Natural gas, let's just have a look at the ETF. This is one that I don't know this market very well. I know it's cyclical with the long winters in the different hemispheres, but I don't have a lot of commentary on that, other than it is a bit of a byproduct of oil, a little bit like silver is a byproduct of gold and other mines. And uranium is the one I know plenty of you are interested in. This is Uranium Etf. That was a nice capitulation if you'd been looking to get in. And I know it traded around this sort of $10, $12, $11 mark for ages. It just feels like it's been forming. And this looks like an altcoin, doesn't it, guys? The crypto crowd, let's put it on a monthly just so you can see that. This is a typical run up, huge bubble. Then we have the Fukushima event. Everyone thinks we're never going to use reactors again. The truth is that we're definitely always going to use them, and there's still hundreds of nuclear reactors, and some people just don't understand that at all. And then we've had this grinding, and maybe that was the final capitulation, and well done if you got in at $7, $8 there on the URA Uranium ETF. One of the biggest companies in the world that I always just check out as well is Uranium Energy Corp. Marin's got plenty of free stuff on his website about all of this as well. So that's a quick look at the commodities prices. One I will do, just want to show you if we've got lumber futures here. Now, a bit of a strange one, but this is another interesting story to understand to come out of the whole COVID situation. So the price of wood went from $250 a pound to nearly $950, and a lot of people were thinking people are never going to build houses in a recession. There's going to be no demand, and the initial movement is the price to plunge. But then the supply chain breaks down. A lot of people want to move to the country, and all of a sudden there's a lot of people that want to build a house, a wooden house, and get out of the city, and we saw this huge demand. So there's always, I guess, two sides to every story. There's a buyer for every trader. For everyone that thought that the price was going to crash, there's someone saying, hey, I'm in the real world seeing huge demand, and this is how the futures contracts and the markets can work. So that is just something that's interesting, and I think we're going to see a lot of these other interesting, unusual dynamics that just haven't been in the market for those number of years. So I'm going to whip through a lot of these other slides more quickly now that I guess, set that picture. So here we can see the US dollar versus gold. Obviously, they trade pretty much correlated to each other inversely. But I want you to understand that this can break down. So I know that gold is priced in US dollars whenever we talk about it and trade it. But money can flow into both of these at once at the same rate. Okay, and that is something that some people don't understand. So think about gold as now competing on the world stage as another currency. And when we look at gold priced in some other currencies, we know how well it's done. We just saw the Aussie dollar price of gold. And here we go versus some others here, the year-to-date percentage change. So huge moves in Russian ruble, some other currencies. So keep that in mind that we might have a scenario, and I know some people have never seen this in their life, and it might be one of these rarities where there's trillions of dollars out there. Maybe it all flows out of emerging markets, or it flows out of tech stocks, and it flows into US dollars and into gold at the same rate. So the price of gold that we look at on a chart might be going sideways, but relative to where you are in the world, it might be the best investment you've ever made, being in gold, because your local currency is just getting smashed. And why I think a lot of the commentary, whether it's Twitter or YouTubers or macro investors, a lot of it is always focused around the US. And if people see a sideways, boring gold price because it's in US dollars, that doesn't mean that it's not a huge stellar performer in 100 other countries around the world. Again, really important to understand that. Now, typically for years and decades, we've had bonds as the place where you can go. So if you've made heaps of money and you think there's some headwinds, a recession ahead, the stock market's overvalued, back in the day, you just rotated it and took profits and bought a bond, and you got a yield. Now, how easy is that? Here we see the corporate bonds real yield. So even as you go down that scale or up the risk scale, and you go from a US Treasury bond where they're always going to pay you. It's not like you've got to worry about Argentina defaulting on a bond. The US is considered so safe because they're always going to pay you. It's just a matter of, well, how much is the currency going to be worth? If they've got to print heaps of money to pay you, then the currency might be a little bit worth less, so to speak. But for the first time ever, we've got even the corporate bonds that have a high yield because of the risk that you're taking. They're now offering a negative real return. So why would you go and buy a corporate bond from an oil and gas explorer, or maybe it's from the commercial real estate market, and they're offering 7% yield, but inflation is 7%, or CPI in the economy's shrinking and inflation's 5%. Whatever the numbers you've got to crunch to get to the end point here, but the fact is, in real terms, when you consider the economy and the cost of living and inflation and what you're actually getting, you're getting a negative real return. So it doesn't really make sense to do that with the additional risks. Now, when we look at interest rates around the world, it's a very similar picture. So these are the bond markets for all the different countries. And why is Argentina offering 45% on a 2-year bond? Because they're probably still likely to default. So even though they're denominating their bonds in US dollars and they're promising people to pay them back in US dollars, people are saying there's a pretty high chance that they're just going to default on that. So do you even take that risk? Now, some other countries haven't quite gone negative yet. Look at in Australia, that this chart's a few months old now, from July, but that 30-year bond was pretty attractive compared to a lot of places around the world where you're getting a negative return guaranteed. But now the question becomes, is Australia going to have to start printing a lot of money? So yes, it's an okay return, but are they going to have to start doing what everyone else was doing? And do I want to take the currency risk And so people are really questioning the whole bond market. And remember, this is a massive market that's never been questioned before. Some countries have, the Argentinas and whatnot, but the US in particular, there was never any reason to question. That was just the gold standard, considered the risk-free rate. And for the first time ever, that may not be the case. And that does change everything. You know, trillions and trillions of dollars may be about to go into these other markets like gold. And that does kind of reprice it. You've really got to think of it differently. This was a number I spoke about at the start of the year, saying that I think this is going to bounce and get back up to the old all-time highs. And, you know, we had 18, 17 trillion of negative yielding debt. It got down to 11. It's back to, what's that, around 14. So 14 trillion that may be looking for a better place to find a home. Now, this is where I want to sort of tie everything together in terms of that big commodities super cycle and what's happening at the moment with the US and China. Money printer go brr is this meme that we talk about, where all the central banks are printing money and there's these currency wars and they talk about it as a way to stimulate the economy. But what we're finding out is that a lot of that money doesn't get into the economy. It sits in the banks as reserves. They're a little bit scared to lend. You know, just today, I might bring that up. Just today in Australia, for those of you that aren't familiar, we got this news that the responsible lending laws are going to be axed. So we literally, you know, in Australia, we haven't had wage growth for 10 or 15 years. And so the only reason house prices and everything's going up is because interest rates have come down and people are borrowing more. And the average family with two people on okay jobs that are willing to borrow $1 million, and it's really scary. So it's just not affordable. The household income to mortgage or affordability and house price ratio is up, you know, around 10 or so. We've got record household debt. I think we're number 1 or 2 in the world in terms of household debt. So it is nuts where this is going. There was a big global study. We spoke about this in our documentary we made, and Australia got 10 out of 10 every category in the real estate money laundering. This was a global international study, and they came and looked at, you know, Chinese and whatever it is, mafias and that, and they're just laundering all this money through the Australian property market and propping it up. We had the big Royal Commission after all this, and Commissioner Hayne was understaffed and underfunded, and they didn't get enough time to really do a good job. And they still found that everything was just terrible. They've recommended all these changes. They started to implement a couple of them. And then the housing market started to turn down. This was even before COVID or the bushfires or anything like that. So Australia was already the housing market had corrected and it was a little bit shaky. And they said, whoa, we need to peel back those changes. We need to encourage people, you know, to take out more of those interest-only loans. We need more investors to come back in and start speculating, because they got to a point where they were like 35 or 40% of the market. They were holding the market up. Now we're going into recession, and so people are going to start losing their jobs or getting less hours. There's going to be, you know, less money. And so the answer here to save the property market is to axe responsible lending. This just makes me so angry. Like, what universe are we in where, yeah, it might keep prices propped up for a little while, but that person might not have a job, or you're encouraging them to go into more debt. So that is just borrowing more from the future. It's all well and good if we put every 20-something-year-old in $1 million house, but that means that they're not going to have any money to spend on the economy. And, you know, Louis, my son, in the next generation, they're going to inherit this record debt where now the average house is $3 or $4 million, and we still haven't had any wage growth. Like, none of this makes any sense whatsoever. But this seems to be our answer for everything. It's the same with the economy. Things aren't working, so what are we doing? We're printing more money instead of trying to create new innovative jobs and get things growing, where it makes no sense to me whatsoever. And I know some people don't believe me when I say it all comes back to the monetary system, but it does. That's probably a long story for another time. All right, so here we have America's dependence on these rare earth elements, a lot of it from China. Australia would be in here somewhere as well. So this is the United States dependence by source. China is the one that's actually got a lot of reliance on Australia for their rare earth metals as well. But this is just one good example of the supply chains that are not going to be the same if the world stays on the current course. So they'll have to start to try and get partnerships with other countries. Now that might cost more. It's going to change the way that money flows around the world. If Australia and China have their fallout, and Australia's going to have to look elsewhere as well, China's going to have to look elsewhere. All these things are changing the dynamic. There's a lot of people now that are cognizant of renewable energy and not being wasteful. And there's talk about how some countries will start to look at the neighboring countries to see if they can get the same resources, because that's going to cut down on the fuel of traveling all the way around the world to get the same wood or steel from Australia, for example. And these things might cost more, but we might be prioritizing different things. And again, that is a dynamic that hasn't really existed in history. And so I think the price of things, the way the world works, these supply chains, it really can all change, and that can be inflationary. That can put the price of things up. Another thing I've spoken about is commodity prices. So China copper monthly imports, this is growing pretty steeply over the years. Are these other countries going to keep giving away their scarce resources just because someone's running a money printer? America's lifeline to rare earth metals. Is China just going to decide not to give them to America anymore because they're just printing money out of thin air, and China would rather stockpile these and keep them for themselves, just like they're importing huge amounts of copper? If things get really nasty between these countries in trade wars, what's to stop someone just continually printing money to buy all these assets off someone? And at what stage would Australia, for example, say, hold on, whether it's China or the US, when should we just keep giving every single thing that we have got to another country and sit there and be happy that we've got this fiat currency that's not even paper anymore, or it's not even gold in a vault, it's just numbers in a computer? Do you see where I'm going with this? I think this is the big revolution. Now, obviously, everything we've spoken about with gold as a monetary metal, silver, slightly different. It's got those industrial properties, but I think when it got to that historical ratio, that was the time when everyone finally thought, you know what, silver's not dead. It does have a lot of uses. One that we haven't heard about so much lately is its natural antibacterial, antiviral properties. So if we head into another era, a change in the medical world, or even just the real world, we might have to bring in things like every door handle or lift in every building is made out of silver because it has a natural antiviral, antibacterial properties. So we just don't know what the big drivers are going to be. Maybe it's a huge renewable push and we have it in the solar panels. I just think that we are going to have demand for real things once the big spending starts to try and spur growth. Rather than go into financial markets, I think it's going to go into these real things. And like China are doing with the stockpiling, that starts at the sort of commodity level, and then it goes, well, how can you value add to that commodity? And then how can you start a business and make things from those? And then you make the components, and then someone manufactures and makes a device or an invention out of it. Then we have the software and the technology, and that requires the gold and the silver. So you can see where I'm going with this, that I think the winner of all of this is whoever makes the most things, the best technologies, the inventions. It's not whoever makes the best financial products on Wall Street, which is what's been happening for 10 or 20 years now. It's the guy that sits there and makes the best derivative or has the best arbitrage trade who gets rich. And I think that is something that is really going to change the world. The world leaders and the biggest powerhouses can be determined by something as simple as that. Again, remember, it all comes back to that monetary printer and the fact that the US have that privilege of being the world reserve currency. So that's where we currently sit at the moment in terms of all the commodities and what I think is going to happen. Let's have a quick look back at this chart. The US dollar is at this make or break, make your mind up inflection point, and that now fits with the news. We are literally waiting to see if another bill is going to be passed. Now, it looks like they're a little bit closer than they have been before. One party wants 2 trillion, the other didn't want to spend that much. Both of them want to look like the hero and the good guy at the last minute. But then we've also got the Federal Reserve. Now, they're sort of holding off and they don't want to pull the trigger. They've already bought a couple of trillion this year. There's a lot of money in the Treasury account that Stephen Mnuchin has at his disposal. It might not be enough to cover the $2 trillion package, but they've got, I think, $1 trillion in there. Now, let's talk about having these direct payments. We've touched on this in a lot of the interviews we've done, where this may be more inflationary than all the QE in the past, where the Fed are printing money to buy bonds off distressed companies or to give to the banks, and they're sitting there in those reserves and topping up their reserves, but it hasn't got into the economy because there's not a lot of appetite to borrow, particularly with small businesses at the moment. So these direct payments, if they give everyone a lot of money into their account, that can be what we saw at the start of the year when the price of groceries and things went up very, very quickly. So the Fed are pleading for a new stimulus and markets start to give up on hope. One of the things I've said a lot over the last couple of years is every time we've had a dip, a lot of you are saying, aha, this is it. This is the big crash we've been waiting for. And I've sort of said, I don't think so. There's, the Fed are always going to come in, and markets like to hold them hostage. Markets like to sell off as sharply as they can and really scare the Fed. Like when Powell was the new chairman, he had to do that big 180 and go from saying, we're raising rates, we're unwinding our balance sheet, we're selling bonds, and the market just completely flipped out. And then within a month, he had to say, hey, that's all cancelled. We're dropping rates back to zero. We're starting to print more money, and off we are to record new highs again. So that's kind of the picture we're in. The same thing in Australia at the moment, where for months and months, or for years, Philip Lowe and the RBA, they were very quiet in the background, and there was no talk between our government and our central bank like we see with Trump and on Twitter and that big dynamic there. Now, just recently that's changed with Philip Lowe almost telling the government you've got to be spending more, and they haven't really done that yet. So he started trying to tell the states you've got to spend more. We'll force people to buy state bonds off you. Another example of just things that have never happened before. And Paul Keating's come out and said, the RBA are not doing enough. And I kind of tend to agree. And even, Kook on Twitter, who I don't always see eye to eye on, he's been very critical of the RBA, saying, now is not the time to worry about being tight with what you're doing, because relative to everyone else, you're already being really sensible. And that's why the Aussie dollar's got so strong, because you're not just running the money printer at full speed like everyone else. And it's almost too late. And the central banks have always been too late around the world, but particularly in Australia. So we are already in a recession. They haven't really done a lot considering the magnitude of the situation. And they're trying to get the government to do more. They're saying, you guys spend. And they know that they don't have any bullets left in the chamber. They're basically at zero interest rates. And they've spoken about how they don't want to go negative and they don't really want to print money unless they don't have to. So they're hesitant to do those things, and the government are kind of hesitant to spend because they were promising everyone a surplus. So you see where I'm saying, where everyone's kind of being a little bit careful at a time where every week that goes on, where there's someone that falls through the cracks, that doesn't get those payments, they end up homeless. Or the unemployment rate is so high, and we've got these people on sort of life support, just keeping them there. And Australia just announced this week they're going to change those rules and basically keep zombie companies alive. So see where a lot of these businesses would have failed, and those people would be starting to look for new jobs or maybe starting a new skill. But at the moment, they're not there available to do that. They're just being kept in these businesses that are going to die anyway whenever they reopen. So it's like the worst possible case of kicking the can down the road. And this article kind of talks about that as well. Ray Dalio and a lot of very smart people are talking about, the threat to the US dollar. Look, he's not buying Bitcoin, but remember, some of these guys that manage billions and billions, or when we get into the world of trillions, that can't go into Bitcoin. That's one of the reasons I was always so bullish on gold, because the big boys that have to move $100 billion in a week, they can't put that into Bitcoin. I know some of you would love that, but that's when they're going to go into gold or the US dollar or something really liquid. And at the moment, I think gold is just, it's almost like the bigger it becomes, the better it becomes as a liquid sort of asset that people can treat as a new reserve currency of sorts. So this is the threat to the dollar that Ray and everyone's talking about. This has gone up by a couple of trillion this year. The Fed didn't buy all those bonds, so the government have spent $6 trillion, but the deficit's $3 trillion. They're trying to. They need someone to come and buy another $3 trillion of bonds off them, or they need to collect that in taxes, but that's obviously not going to happen. So the Fed don't want to buy that because that's kind of bad for the US dollar. What does it mean next year that they've got to print 10 and then 20 the year after? And then you end up with this hyperinflation and the dollar's worthless. So that's what the Fed are being cautious of. But the government kind of need to step in. The reality is that, they're spending way too much. But the alternative is that you don't, and you end up with, homelessness, more businesses failing. And this is why everything that people have been saying, like Peter Schiff and Ron Paul, all the libertarians for many years, is that you can't just keep going on down this path and turning a blind eye, and it's all unsustainable. Because it all looks great on the stock market when every quarter you have more paper wealth. But that's just, as I said at the start, money going into pretend things. At the end of the day, we could have every stock market in the world at record highs. That doesn't mean anything if we've got no lumber. We've lost all the businesses that have finding the oil and the gas, because the Fed have been buying all their bonds and the companies kept issuing the bonds. We've kept these zombie companies alive, but they don't do anything, and the infrastructure is broken down now. The bridges and the roads and things that we should have been rebuilding. Do you see where I'm going with this? It's all well and good to paper over things and pretend that things are great and push up the price of assets, but it's the real world, real value, real growth that comes from real things. Something else that I really think is changing is that idea of everyone living in the big cities, and that's where a lot of the financial world has blossomed, and all the money kind of goes out from there. I think the most premium lifestyle is no longer going to be living in the city. It's going to be living in a nice town with plenty good supply of local farms and produce, clean air, clean water, no threats of violence or lower compared to the cities. Do you see what I mean? And that's kind of the lifestyle that I always wanted to live in, why I chose to live in Tasmania of all places. And I think a lot of people that are in Melbourne right now would love to be down here and going to the farmer's market tomorrow morning to get our fresh produce and being able to go for a walk and go to the park for as long as we want. What are those things worth to you compared to celebrating that your house has gone up 10% and someone's going to come and buy it off you for $1.1 million next year? Is that even a win? If you want to upgrade to a bigger house, you've got to take out a $1.3 million mortgage. Is that really a win? These things are all relative on what we're sort of valuing. And at the end of the day, a lot of it is just this reflection of, hey, print more money, global money supply, and have a look at stocks. It's just the tightest correlation, and we shouldn't really be surprised that stocks go up at the rate of money printing. But where this is changing, it's that value versus growth sector. And that, just like we spoke about with the commodities, these are the ratios that are getting to extremes. And so let's sit back and think about, why is money flooding into all the tech stocks at the moment? Well, we've got all these Robinhood retail traders that are bored, and we've kind of made it really easy and fun to invest. A lot of these people got $1,200. What are the 5 stocks that they know? Well, it's, Apple, Facebook, Tesla, the things that are in the news every day or that are popular on social media. So those companies have just got the benefit of all that. At the same time, we've got all the indexes that include those, and it becomes like a self-fulfilling prophecy and a momentum thing. or more of them that have in each other's index, then it all goes up. You've got central banks like the Swiss National Bank that are buying all these tech stocks with printing money out of thin air. I heard a good interview with Real Vision today, Raul and the guys, and they're talking about how a lot of the older baby boomers that are retiring, they own very different stocks. So all that money is going out of those stocks and being sold, whereas the newer stocks, it's just like all this money is going in, and a lot of the baby boomers don't own those newer, flashier tech stocks. So that's why we're seeing the scales tip. But a lot of these companies have also got a lot of cash on hand. And when you say, well, what companies are going to survive and who's in better shape, it's the tech company with $100 billion on their balance sheet that is in a lot better shape than the oil and gas explorer that's got billions of dollars of debt and they're continually issuing bonds. Now, recently we saw MicroStrategy that have all that money on hand choose to buy Bitcoin, $500 million of Bitcoin. That is a huge statement saying that we're so worried about the Fed and the government spending and printing dollars that that's going to get devalued that we actually think Bitcoin is a better bet, even if it is volatile. Now, maybe we see some companies do the same with gold, the ones that don't like Bitcoin. But it's a huge, huge statement. Like we said, for the first time in history, a lot of these things are happening where people are still thinking about it in the older way, the traditional sense. They're saying to their manager, let's rotate into bonds. Let's just sit in US dollars. Where you can go, that's no longer the same case. Now, another sector that all of a sudden is going to be in the same shape as tech stocks in a couple of years is the gold miners. Let's look at the free cash flow here. Now, this only goes to 2018, and this is Australian miners versus American. Now, as we saw, the gold price in Aussie dollars is up another $1,000 since then. So some of these Aussie dollar gold producers that were making $150 an ounce back in 2014, it might have cost them $1,000 an ounce. Same with the American miners. Let's say that their cost was about $1,000 an ounce. This is the profit here. American miners, they're not making any profit. Now, all of a sudden, the Aussie gold miners add another $1,000 onto it. They're making $1,500 per ounce, and some of these guys are mining millions of ounces. So their balance sheet is just filling up with billions of dollars. This is no longer can you view them as a mining company, really. These are literally cash cows. The old saying, you're sitting on a gold mine. This is the way you need to start thinking about it. It's almost like an in-ground ETF of the hardest asset. It's all well and good knowing that a bank has cash in reserves or a government has US dollars in their foreign cash reserves, or a company has plenty of money on their balance sheet. But a gold miner has millions of ounces of gold in the ground. That is a huge, I guess, almost like a safety defensive play, rather than being considered these risky minor plays. So again, something that's never really happened before. In the grand scheme of things, the bull market, we are very, very early. This is only a couple of months old. Everyone's saying, is it too late to buy? Well, the only people that have already made huge gains are the guys that were there in the depths of the bear market and the true gold believers. There's some newbies coming in just now, like Warren Buffett, but there's a long way to go when you consider the, I guess, typical percentage returns and what is possible ahead if things continue on the current path. Now, I want to tell you a story about a mistake that I made. So when I started investing in all these gold and silver stocks, and I was a bit of gold and silver bug, immediately you hear about it and you think, should I just buy some gold and silver? Maybe you do. But then you start to think, well, what about that junior mining company? That might go up more. And then you say, well, what's the silver mining company? And what's the silver explorer? Now, obviously, I found one that was called SVL, and I'm sure plenty of you know that or even invested. And they were super risky. They had to keep, year after year, they had to keep just raising more capital from investors because they're exploring and they're not producing any profits because the silver's in the ground. And every year when I was very early on in my, I guess, investing career, you watch those videos and someone tells you that silver's going to $600 next year, and you think, oh, I'm going to be so rich. And, they're the mistakes that I made. Now, I also, luckily, I was a little bit sensible, and that was only one of the companies that I invested in out of a dozen. And I invested in about 10 or 12 Aussie gold stocks. Here you can see them. And this was my ticker. So Hot Copper is an Aussie stock trading forum. I was very active here for years before they banned me in 2018 or 19 because they thought crypto was a scam and that I was spamming with scam videos, even though I was just sharing my educational videos. But here you can see a thread that I made called "Who Sold at 7 cents?" And this, I didn't get to buy at 7 cents, but I think I got a little share, a little fill at around 10 cents or 12 cents, whatever it was that day or that week. And this was a company with a very interesting story, and people thought that they were going broke. And we covered this one again just recently in October in our premium research. And so this is another example, the same as in the crypto world, where people think that a company is about to go bankrupt, whether it's an altcoin or a gold mine. Then that's when that capitulation and that give up, that marks the low generally. And it is the same in the mega cycle that we saw in the commodities world. So a lot of companies were going broke. And remember, a few years prior, gold and silver at record highs, and they're buying all these companies and spending like all the ICOs were spending when they thought they were rich. And it's that harsh reality, that business cycle, boom, bust. And now this company is trading at around, I think it hit $5 the last couple of years. So that is obviously enormous returns, not quite 100x. But just a great story of these Aussie gold companies that most people had given up on. And if you're a true believer and you did your research, most of these are 10, 20, 50 or 100 bagger stocks. And you didn't have to go finding the little gems. These are just, if you Google search, what are the largest mining companies by market cap? You don't have to get too funky. Now, I don't own these anymore. So full disclosure there, I'm not shilling my bags or anything. I've rotated out of these and they've had an extraordinary run. And I think there's different places that I want to park my capital and what I do, my personal reasons, where I'm at in life. There's all those things that are going to be right for you. But I think that even just owning an ETF is a good way to go. And that might be something that I look at, or maybe look at which one of these is paying a good dividend and redeploy some capital now that we are having a bit of a pullback. You've got to decide all those things that are right for you. So silver, we covered in detail on YouTube as well as in our reports. These are the precious metal ETFs I've spoken about a lot. Now, we did one of our reports on the components of those and being aware of which ones are the most heavy weighted and how that actually benefits the stock. From when there's more and more investors in these different gold ETFs, sometimes they have to buy more shares of these different companies. And Newmont and Barrick are the biggest two. And it's no surprise that Warren Buffett recently got into the game and he bought Gold Corp, Barrick Gold, sorry. Now that one is actually trades on eToro. So these guys have added more gold stock recently, and I actually like the fact that they've added the big two. Like, you don't want to be adding these triple leveraged ETFs, inverse products, low cap spec junior miners. Like I said, that's where I got in a bit of trouble with SVL. If I had have just invested in blue chip stocks or even just the ETF, I would have done really, really well. So that is available there. All those US stocks are zero fee trading, guys. So that is what Warren Buffett got into recently. And I think that tells you that mindset, like I spoke about before, that now some of these American miners as well, they're making $1,000 more than this chart in that free cash flow. And for him, it's almost like they are the new tech stocks, the new cash cows. It's a very interesting decision. So look, if you are interested in that, guys, we're always running that $100 sign up bonus. That link's down below. But let's tie this all together. Let's go full screen here. So we've got in the blue the stock market, orange is Bitcoin, gold is gold, and the candles are the US dollar. So here we can see that daily chart that we spoke about with the US dollar touching that previous level. Now, I know you can't quite see this when it goes behind me, but you can see that this is just a beautifully inverse pattern here. And if we can get these stocks to have a little bit of, get the dollar, the currency, to have a bit of a pullback here, if it has found resistance, then I think that is the excuse where the dollar resumes its downtrend. What happens here? It's happy days for stocks, gold, Bitcoin. They have a huge run up, and the dollar resumes that huge run down. That gives it the free pass really to resume that bull market. So that's the Goldilocks scenario. Obviously, the opposite is true. If the dollar continues to have a huge sharp rise, or for some reason we have a really nasty round 2 of lockdowns or whatever it is, I hopefully I don't see that happening now that we have more knowledge about it. But look at the steepness of the rush to the US dollars when there was a panic, and look at the sharpness of the drop here of these assets, stocks, Bitcoin and gold. Now, is that going to happen again? Is the rush going to be as steep? Is this time around the US dollar looking at negative interest rates, bigger debts? The bonds aren't the flight to safety that they used to be. So actually, let's bring up bonds as well. Is it TN1? Yes, bond futures. Here you'll see, this was something we spoke about at the time as well, the smart money that rushed to bonds. And they rushed to bonds starting off here a lot more before the rush to dollars. So the bond market investors, they kind of were rushing here and rotating out of equities before they fell, before that crash happened. A lot of them had put the majority of money in bonds as a safe haven before the majority of that plunge took place. So you ask yourself again, well, if we have a round 2 or whatever it is, are bonds still as attractive as they were last time around, or have things changed for good? So guys, that is what is on my radar. I know you guys are used to me doing these with Marin, the monthly updates, but he's very busy and had to have a month off. I know he does. He talks about his returns sometimes. I mean, don't we all? I know I do, but have a look at this. This is some of his alligator investing that he talks about, where he's patient and he stalks those stocks. 523% return in under 2 years. So guys, I know he talks it up, but he is a good investor. And if you're a serious investor, we've got a discount for his research, that link down below as well. That is it for tonight, guys. I've gone an hour. Head over to nuggetsnews.com.au. We've got the discounts for all our partners over there. If you want to join our community and get all our premium research reports on the gold and silver, as well as all the crypto stuff, the macro stuff, that's there to join. Welcome to everyone who's in the group. We are about to cross 4,000 members. It is absolutely awesome, the standard of posts that you guys are doing in there and helping each other. We've got more moderators. We've got another. I'll announce it on Sunday night. I've got a bigger surprise for you guys that you're going to love, and I'll talk to you then. So cheers.